Hi, my name is John Collins, and I work at Southwest Funding. And we're going to start a series of conversations regarding the first steps that you should take to get ready to buy a home. If this is your first home, there's some valuable information in here. And I just want you to know that if you ever have any questions, feel free to reach out to me and let's clarify those questions. Buying a home is not really a difficult process. It's just that a lot of people don't know what to expect and what steps to take and in what order to take them. So today, we're going to demystify credit reports. Credit reports are an important tool that the industry uses to determine if someone is qualified and has the ability to pay for a home. And so we're going to go through some of the things that are going to be on your credit report and several things that a lender is going to look at after obtaining a copy of your credit report. So, similar to building a house on a firm foundation, you can think of your credit history and scores as the foundation to having a smooth home purchase experience. Just like anything else, this takes a little planning and forethought to set the stage properly. So preparing to buy a home is not really difficult, but there are certain steps, and you're going to want to take those to make it easier. The very first thing is to get with a mortgage consultant to do a credit health checkup. That's what I like to call it. I like to call it a credit health checkup. Let's find out where you are. I recommend doing this 3 to 6 months before you're ready to begin looking for a home. Improving credit scores and paying off debt is not always an overnight process. So you want to give yourself enough time that if there is something on that credit report, you have enough time to make the changes to increase your score or to eliminate negative things on your credit report. So the very first step is to determine your mortgage credit score. A mortgage credit report is different in some aspects than the credit report that you, the consumer, can obtain. When lenders pull a mortgage credit report, they pull what's known as a tri-merge credit report. This contains information from all three bureaus, including Experian, Equifax, and TransUnion. Now, each bureau rates credit events differently, and that is why you will have different scores with each bureau. Also, not all creditors report to all three bureaus. So you may have a higher score with one bureau than you have with another credit bureau. Mortgage companies will then take the middle score. So they're going to throw out the high score and the low score. They're going to take out those two scores, and they're going to use the middle score to qualify you for a mortgage. And more importantly, for the type of mortgage product you qualify for. Generally, conventional loans have a higher credit score requirement than government loans. And with different loan types, there are different fees involved. So an FHA loan has different fees than a conventional loan. So let's talk briefly about what affects your credit score and how your actions could improve or hurt your credit. So one of the most important things on your credit report is your payment history. Your credit score is determined by how consistently you make your payments. Are they on time? Have you had a lot of 30, 60, or 90-day late payments? Just to put it simply, the more on-time payments you have, the better the impact on your scores. The more late payments on your report, and your scores go down. But it could get even worse. If you don't pay your bills, it could result in a public record on your report, such as a foreclosure, a tax lien, or a court judgment. And this could actually prevent you from getting a mortgage. So keep in mind that payment schedule is very important. Okay, let's talk about credit usage. The amount of credit you use is also an important factor, and really it's a balancing act. Understanding how your credit usage affects your credit scores positively and negatively is important. Most installment loans, such as a mortgage, an auto loan, or student loan, will positively affect your credit score if your payments are current and on time. Credit bureaus like to see a mix of different types of credit accounts, such as a mortgage or an installment loan, and then revolving accounts to build a balanced credit scenario. All right, so what is a revolving account? Revolving credit is also known as credit cards. So you're going to hear it referred to both ways when you talk to your mortgage consultant. This is the one that can affect borrowers the most without them realizing it. How much of your available credit limit on your credit card you utilize affects your credit score. Using less of the available credit is better and helps improve your scores. Using too much and your scores will drop. I always advise borrowers to try and keep their credit card balances below 30% of the available credit limit. For example, if your credit card limit is $2,000, then never allow the balance to go above $600. Anything above that will begin to impact negatively on your credit score. This is not a hard and fast rule, but it seems to keep people out of trouble, and their credit scores seem to like it. And it's also important to remember after you receive your pre-qualification not to allow your credit card balances to creep higher. All right, let's move on. Let's talk about the length of your credit history. So the length of your credit history can affect your credit scores. Now, these include things like the age of your newest account, the age of your oldest account, and how recently you have used an account. Opening a new account could affect the average age of the accounts positively, but it could also hurt your scores in the short term. This is one of those factors that make it important to talk to your mortgage consultant early before opening new accounts. Let me say that again, before opening new accounts. Okay? The next thing we're going to talk about on your credit report, they're going to show credit inquiries on there. Now, when a lender requests to review your credit report after you applied for credit, it results in what's called a hard inquiry. Now, there's two types of inquiries. We're going to talk about the second one in just a second. The hard inquiry is the first kind. These credit inquiries, when someone checks your credit, can stay on your credit report for up to 2 years. But don't let this stop you from shopping for a loan. Credit scoring models, okay, that's what the credit bureau uses to come up with your credit score, and each bureau is different. They recognize that consumers want to compare their options. So multiple inquiries for certain types of loans, like a mortgage loan, may only count as one inquiry, and you typically have 14 days to shop for these kind of loans. So if you're shopping for a mortgage loan and you go to several different lenders in a 14-day period, it's only going to count once against you. So that's important to keep in mind. A lot of people, when they come to me, they don't want me to pull their credit because they're afraid it's going to affect their credit score. But that's not always true if they're out shopping for a mortgage with several lenders. Okay, the second kind of inquiry is what we call a soft inquiry, like those that come from checking your own scores and some certain loan and credit card pre-qualifications. These don't hurt your scores. It's important to remember that 10 days, though, before your mortgage closing date, the lender is going to obtain a soft inquiry to see if anything's changed in your credit. The lender's looking for new credit accounts that didn't exist at the time of pre-qualification and increases in revolving credit balances. So if you get pre-qualified for a mortgage and then you go out and buy a new car, that soft inquiry is going to pull that new account up, and that could result in you no longer being approved for the loan. So this is very important to remember. I'm going to say it one more time, though. If you are pre-qualified for a mortgage loan before you make any major purchases or you increase your credit card balances, talk to your mortgage consultant first to make sure it isn't going to result in you losing your approval. Okay, so let's talk about the point at which your mortgage consultant has obtained your credit report, and now what? So your mortgage consultant will discuss with you what's on your credit report. And if there's anything that would prevent you from obtaining a loan, then he or she is going to go over these items. And items could include large dollar amounts of outstanding collections, unpaid court-ordered child support, and other such items. Additionally, they will discuss possible ways to increase your credit scores, and these could include paying down credit cards or eliminating altogether a monthly payment that you may have in an installment loan. So, to reiterate, I'm going to sound like a broken record. This is why you want to talk with your mortgage consultant 3 to 6 months before shopping for a home. Often, it takes some time to improve those scores because of available money you may have or not have, and to accomplish the goals set out by your advisor, and then also the lag in credit reporting. After you are in contract to purchase a home, there's some guidelines you want to follow as well. Some of these seem obvious, but I think they're worth pointing out. So you're in contract and you've been approved for a loan. And one of the things that happens sometimes is people decide they're going to quit their job or they're going to move to another company. So don't quit your job unless you have an offer in writing from another employer indicating your start date, the position you're going to have, and your annual salary signed by the HR or the manager. Get that letter in writing. And then you want to let your mortgage consultant know immediately of your plans, as it could affect the timing of your mortgage. Another thing, we've said this before, don't make a large purchase like a car or other expensive purchase. One more thing, don't miss your current monthly mortgage payment if you have one. Talk to your mortgage consultant, especially on a refinance, and when to not make another payment, especially on a refinance loan. This is important because we get, if you have an existing mortgage, we get what's called a payoff letter. And that payoff letter has a date that it's good to, kind of like an expiration date on the milk. And so if we've obtained that letter, it includes any interest up into that date. And so you want to know, do I need to make my next mortgage payment or should I hold off on it? So talk to your mortgage consultant about that and they'll let you know. So that is pretty much the first steps in becoming approved for a mortgage. And this is the putting the horse before the cart. A lot of people go to a real estate agent when they're beginning to look for a home, and a good real estate agent will ask you, are you pre-qualified? So I highly recommend that you call the mortgage person first and then go to the realtor. And when they ask you that question, you can present them with a pre-qualification letter and you can go out immediately and start looking for homes. So if you have more questions or you want to discuss your current financial situation, please email me at the address in the description, or you can call me at 208-497-5577. In our next video, we'll talk about what factors will determine your maximum mortgage amount. I appreciate you listening. I hope this has helped you out a little bit to demystify credit reports. My name is John Collins. I work at Southwest Funding. Have a great day.